I guess over the last number of years, we've all experienced extreme volatility in public markets, both on the equity side and also on the fixed income security side. I guess if you're looking for an allocation to an asset class which is uncorrelated to equity markets and other public markets, provides a hedge against inflation, provides regular, reliable, attractive income, then please consider an allocation to Australian corporate debt. When we launched our first fund about 11 years ago, it was the first time Australian investors had actually been able to access this asset class in fund format. And since that time, over the last 11 years, and thanks to the support of our many investors and the performance of our various funds, we now manage over 17 billion in corporate loan, Australian corporate loan assets. And we operate over 22 funds, giving investors a whole range of different options and different ways to access their asset class. Over that time, we've increased our team. We started with 3 of us in a corner of a lawyer's office in some rented space, to now having over 137 people in our business. And about half of those people are involved in the direct origination and structuring of loan transactions, and then the ongoing portfolio management of those transactions. We're a bit different to other managers operating in the market in that I guess our size sets us apart, being the largest non-bank lender in the market, but also because we look across the entire market for opportunities. We don't just focus on one particular market segment, be it high yield leverage loan market. We actually look right across for the best risk return opportunities for our investors. And so the way we look at the market is in these 4 segments. And so we provide funding for ASX listed and private corporates. We provide finance for private equity owned portfolio companies. We do quite a bit of commercial real estate lending. We're actually the largest commercial real estate lender in the market. And we focus predominantly on short-term development funding in both residential and industrial segments. And then we also do project finance. And so lending on things like toll roads, hospitals, rail projects and the like. I guess what is private debt? Many people think it's actually new. It's actually not new. It's actually what banks have been doing for hundreds of years. What's new is that we've actually opened it up to enable investors to directly access this asset class. Private debt is evidenced by a financial contract, an agreement between a borrower and a lender that's negotiated often over a long period of time. You know, sometimes it takes weeks, even months, before agreement can be reached over the terms of a loan. And those loan agreements contain a range of financial covenants, a range of reporting requirements, whereby borrowers are required to present to the lender on a regular basis a lot of inside, detailed, often commercially sensitive information about their business and about its performance. And we use that information to actually monitor the performance of the borrower. And if we notice any deterioration in that performance, under our loan agreements, we have rights to actually step in and require the borrower to make changes, whether it be raise more equity, sell assets, whatever it is, to protect our position as a senior lender. And importantly, the loan agreements also contain security provisions. And so most of our lending is secured. We have mortgages over real property, so over real estate. We have fixed and floating charges over businesses. And often, in many cases, we have personal guarantees from business owners or sponsors. Private debt covers a whole range of risk return options. So at one end, there's high investment grade borrowers, all the way through to sub-investment grade borrowers, up and down the capital structure, so both senior and mezzanine debt, and also for higher yielding opportunities, there's where debt is transformational, we can sometimes negotiate to share in the equity upside of a business. So we have equity-like businesses, so in the form of warrants, options, or preference shares. The market is also very diversified. So if you think about Australia, this here on the right, private debt covers all parts of the Australian economy. So it's really the only source of debt for corporate Australia, for borrowers. There's not really in Australia any other option. If you want debt capital, you really have to go to a bank or a non-bank private lender. We don't have a corporate bond market. The only people that can really access the corporate bond market are people with strong investment grade ratings. And there's not that many of them in Australia. Most of our borrowers are sub-investment grade and unrated borrowers. Why does this opportunity exist for people like us? And there's two main reasons. So after the global financial crisis, banks globally were required to allocate capital on a new standard called under the Basel Agreement. So Basel II, you may have heard of that. What that meant was for riskier assets that banks traditionally held on their balance sheets, so sub-investment grade loans in sort of simple terms, they had to allocate a lot more capital against those assets. And what that's actually meant is that it's made those assets very unprofitable for banks. And so what we've seen globally over the last sort of 15 years since the GFC is banks trying to reposition their balance sheets away from holding those kind of assets. And you've seen in Europe and the US an increase, a very strong increase in the number of private debt lenders in the market. The second thing that happened in Australia is that about 6 years ago, APRA started making noises that it was unhappy with the 4 domestic Aussie banks with the level of real estate exposure they had on their balance sheets. And when you think about their businesses, they provide huge amounts of financing for people with home loans. They provide a lot of business bank lending to small businesses, and those loans are also secured by real estate. Often they take held mortgages over the business owner's property, whether it's their house or their business premises. And then they also provided a large amount of funding, particularly to REITs, but also to support office and large-scale commercial real estate development. And so what we've seen over the last sort of 6 years or so is that the banks have withdrawn capital from that kind of activity to reduce their exposure to Australian real estate. And the way they've done that is to take money away from the commercial real estate market. That's actually the quickest way for them to reduce their balance sheets. Obviously much harder and much more challenging for them to actually try and reduce providing funding for mortgages. That would be politically pretty unacceptable. Much easier for them to withdraw capital from the commercial real estate part of the market. And so you'll see there on the chart on the left-hand side, coming out of the GFC, the 4 Aussie banks held 75% of all corporate debt in Australia, to today less than 60%. And you'll see over the corresponding period the growth in the participation of non-banks in this market. And we think that that trend will continue. Historically in Australia too, important to note that Australia is very much a bank-dominated market. And so historically, loss rates have been very low. Coming out of the GFC, you'll see there in the chart on the right-hand side, the peak loss rate. And what's important is not the default rate, it's actually the loss rate. Default rate just means that the borrower is talking to the bank and working through workout mechanism so the bank can be repaid. So the most important line on that chart is actually the default rate. So coming out of the GFC, 0.67 of 1%, and has been pretty negligible since then. And we've seen through the recent reporting season, I think CommBank came out just recently with its results showing that there's been no uptick in their provision levels. And we've also heard, I guess, from previous speakers that, the health of corporate Australia actually looks pretty positive. Now, this is a selection of our funds, obviously retail and wholesale funds. Our platform is designed to provide various investors with a range of different ways of accessing the asset class, depending on what their risk and return objectives are and what their liquidity requirements are. The funds on the left-hand side are really designed to provide a replacement for your normal fixed income allocation. On the right-hand side, those funds are designed as really an equities replacement. So delivering equity-like targeting equity-like returns, but from the provision of higher yielding debt. So higher yielding senior debt, mezzanine debt, and the like. These are just our retail funds, Metrics Direct Income Fund and the Master Income Trust listed on the ASX, both invested in the same portfolio of loans, providing a diversified exposure across 300 names. Metrics Income Opportunities Trust, again a higher yielding ASX listed option, providing exposure across about 160 names. And coming soon, to be launched in the next few months, a platform product, our Real Estate Income Fund, invested just across real estate income, real estate assets. So if you're looking for opportunity to invest in a product that has a natural income, a natural inflation hedge, all our loans are floating rate, protecting you from inflation fluctuations. You're looking for regular income, stable unit price, stable asset price, and the opportunity to invest in a very diversified portfolios of loans, reflecting all of the activity in the Australian economy, then please consider Metrics. If you'd like more information, please reach out to your Pinnacle BDM. You can visit our website or please follow us on LinkedIn. Thank you.